Okay, so for the benefit of everybody's time, and thank you very much for all the ones that have already joined. So good morning, good afternoon, or good evening, depending on the time zone from which you're all getting connected today. Welcome to YIN Mexico's 8th ordinary session of the year 2021. It is with great honor that we open this extraordinary roundtable discussion entitled Taxation on Blockchain, a Mexico, US, and Canada approach, which we have organized with our friends and colleagues of YIN Canada and YIN US, with the sponsorship of YIN Central. So my name is Mariana Guiarte, current chair of YIN Mexico, and I am accompanied here today by my colleague Luis Salinas in his role of YIN Mexico's vice chair. We are both pleased to announce the presence of IFA Central and YIN Central through Claudia Sutter in her role of YIN Central's chair, and Michael Evers in his role as member and YIN representative at IFA Central's Permanent Scientific Committee. Now, being this a joint YIN Mexico and YIN US and YIN Canada meeting, sponsored by YIN Central, we also have the privilege of counting with the presence of Daniel Neer, who is the chair of YIN US, as well as of Kimberly Brown and Sarah Chu, chair and vice chair of YIN Canada, respectively. Guys, we appreciate your willingness to set this joint meeting with us. And of course, we also appreciate all members of YIN Mexico, YIN US, and YIN Canada for joining us here today. We are certainly very proud of the response and have to say that we received more than 170 requests for registration to this event, although we could only accept 100 attendees given the restrictions of our platform. However, the good news is that this session is being recorded now, and that we will make sure that the video is distributed among those that attended or had the interest of attending. So thank you very much. Last but not least, we also want to thank IFA Mexico's President Edgar Anaya and IFA's Mexico Secretary Nora Morales for their support in organizing this joint Young IFA network meeting. And before passing on the word to my colleague Luis Salinas, who will introduce our roundtable moderators, I do need to make some important housekeeping announcements. Number one, again, please remain muted and turn off your cameras during the complete session. And number two, questions can be asked through the chat, and we will make sure that those are answered either during the panelists' presentations or if we have time during the Q&A session. You also have on screen the panelists' contact information in case you want to address directly any question to any of them. And the third announcement, and this is one that corresponds only to YIN Mexico's members, so for which purpose I will change to Spanish for just 1 second. Comentarles, estimados, que toca ya el cambio de coordinación en el comité para el bienio 2021-2023 y que dicho cambio de coordinación tendrá lugar en la próxima sesión de septiembre. Así que quien tenga interés en ser candidato para coordinador o subcoordinador, por favor ponerse en contacto conmigo, con Luis Salinas y con Laura Isunza a la brevedad, ya que deberá presentarse una carta de intención al presidente y al secretario del Consejo Directivo de IFA México, es decir, a Edgar Anaya y a Nora Morales, a más tardar con 10 días de anticipación a la mencionada sesión de septiembre. Entonces es bien importante que quien tenga interés, por favor, nos contacte. So finishing this housekeeping announcements, please, Luis, finally, the floor is all yours. Go ahead, and thank you very much again.
Thank you, Mariana. So we have 6 panelists today. 2 of them are going to moderate the session. So I'm going to introduce the moderators, and then they'll introduce the other panelists. First, we have Laura Georgiou. She's a counselor for IFA Canada and a tax partner with. Can everybody mute their mics, please? So Laura Georgiou, it's a counselor for IFA Canada. She's a tax partner with Gowling WLG in Montreal. Her practices focus on M&A, inbound international tax, and the tech and blockchain space. And Fer Luján from YIN Mexico. He is an attorney at law by the Tec de Monterrey with masters in tax law by Universidad Panamericana. He is a senior associate at Galicia Abogados and co-author of the book Todo Fiscal, Régimen General del Impuesto sobre la Renta, Personas Morales. So with that, Fernanda and Laura, the floor is yours.
Thank you, Luis. Hi, everybody. Thank you for being here. We're really excited about this panel. Personally, I'm excited about two things. The first one is that we will not talk about outsourcing. That's a good thing. That's a Mexican joke. And the second one is that we have brilliant speakers with us, which will help us compare and contrast what is happening in the jurisdictions and maybe reach a common grounds on where we're going concerning crypto taxation. So I'm gonna go ahead and introduce them. First, from the US side, we have Amanda Barma, which is a partner at Steptoe and Johnson in Washington, DC. Her practice focuses on US federal income tax issues. She is an adjunct professor of law at Georgetown University Law Center, where she teaches US international inbound tax. So welcome, Amanda. Second, from the US, we also have Sean McElroy. He's a tax associate at Fenwick and West in Mountain View, California. His practice includes advising clients on tax issues relating to blockchain ecosystem. Jumping to Mexico, hola, Victor, gracias por estar aquí. Victor has a business administration degree from the UTAM and also a public accountant and financial strategy degree from UTAM. He has a law degree at Universidad Latinoamericana and a master in tax law degree from the Universidad Panamericana. He developed his career at Chavez Ruiz Marripa and Bettinger Associates until February of this year, where he opened the firm BMO Advisory SSM. And last but not least, we have also, aside from Laura, from the Canadian side, we have Ian Keynes. He's a tax lawyer at Blakes, Castle and Graydon LLP in Toronto. He told me that his favorite programming language is C. Ian is kind of shy about his second career, but he's also a mathematician. And I think that will become relevant in a few minutes. So thank you guys for being here. I'm going to switch to Laura. Laura, should you introduce the topics?
Thank you, Fernando. And thank you all for being here. From the number of registrants, we see that this is a very important topic. And I remember back in 2017 when I got involved, it was maybe a more, I'm going to call it fringe interest in the tax community. I'm sorry, folks, if we could just mute our mics, please. Really appreciate that. So as I was saying, the blockchain and analysis of the tax implications were very much a hobby, and not so much necessarily a line of work in the tax community. Now it's really become very important to tax practitioners, and we see it not just in terms of investors and minors who are needing tax advice, but also a lot of the institutional centralized government, financial institutions, and other tax authorities themselves, who are looking for consolidation of the tax community's positions on a lot of the ways we should be interpreting how the tax should apply to these technologies. So it's really a very timely topic, a little bit difficult because we have to understand a very new technology for a lot of us tax folks. But today we really are lucky to have a very good introductory presentation to what is blockchain, what are some of the application of blockchain, and Ian promises that he is going to show us an actual Bitcoin. So stay tuned, everyone. Hold on to your seats. Victor, I pass it on to you.
Thank you very much, Laura. Well, yeah, I think this is going to be very interesting. I'm really excited about this because I'm convinced that this technology, this blockchain technology is changing the world right now, and it's changing the world as we know it. So let's go to the agenda. As Laura said, we're going to divide this presentation in two. Next slide, please. We're going to divide this presentation into sections. Through the first section, we're going to see non-taxation concepts, and that is very relevant because that way, by understanding the history, some hard data, why is this important? What is Bitcoin? As Laura said, Ian is going to show us that. We're going to understand blockchain concept applications, exchange, tokens, forks, DeFi. I'm smiling right now because this is really exciting. And then we're going to understand taxation concepts. Then we're going to understand why are there some types of income, some cases which are very interesting actually, and challenges for tax administrations, because this is going to be disruptive for taxation as well. Next slide, please. Let's start with some hard data, because I think this industry is really, really important. Let's say that all the broad money in the world is around $1 trillion, and 2% of this is cryptocurrency. And let me just explain. Cryptocurrency is not necessarily Bitcoin. Blockchain. Blockchain is much more than that. But this industry in particular is 2 trillion, which is a lot. And well, Bitcoin represents 44% of this, and there are other cryptocurrencies that are also great players here. But it's not only Bitcoin or Ether. We have almost 10,000 cryptocurrencies around, and you can actually create your own. So what is important is what supports that cryptocurrency, right? But I also want to say that there are so many people that is saying that you can't buy anything with that, or it doesn't worth nothing. But the thing is that as of today, PayPal, for example, accepts in some countries payment with crypto, and PayPal has 257 million users. And for example, we also have some large banks that are recommending to have some cryptocurrencies in their clients' portfolio. And for example, Visa has already carried out 1 billion transactions in the first half of 2021. So this is disruptive for me, and that's why I just wanted to present this slide. In the next slide, we're going to see some of the history of this of blockchain. These were all ideas in the 80s with a group called the Cyberpunks, who were anarchists. That's where were they. So they didn't like the control of governments in many ways, in many aspects of our lives, for example, the economic one. So their ideas was, this is all about trust, and you'll see this. The value of this technology is that is not controlled by a central authority. And I'm gonna go there afterwards. But in the 90s, there was this first attempt to make a digital payment to this guy called David Chaum. But this failed because of two things. The first thing is that this technology was centralized, so it was controlled by a particular. And actually, I think Microsoft wanted to buy this technology. But the second thing is that they didn't solve the double expense problem. So if you pay, someone else could pay with the same, coin. So that's a problem that actually in 2008 was solved with a Bitcoin's white paper. And let us explain that in that year, as everybody knows, there was a great recession. And there were many people disappointed about some central banks or the control that we have. So as I said, everything is about trust, and in this case, the Bitcoin's white paper was the first blockchain application. Bitcoin was the first application of all this blockchain technology, which is much more than that. But let us say that blockchain is just a database. And what is special about this database? That it can't be hacked, or it's very complicated to be hacked or controlled by someone. So in this case, this database stores information through blocks. So in 2009, we got the Genesis block, the first block that was validated by Bitcoin. So and actually in 2010, there was this guy called Laszlo Hynek who actually paid 10,000 Bitcoin for 2 pizzas. And I really hope those pizzas were good, because today 10,000 Bitcoins is something around $450 million, something like that. So I don't know. And in 2015, there was this new blockchain called Ethereum, which is very relevant and is different from the Bitcoin ecosystem. And the Genesis block was created. This Ethereum, we're going to speak about that afterwards, but it's basically a platform through which you could create smart contracts, which are not executed by human. This is auto-executable. It's a contract that is programmed by some language, but there's no human need. So this Ethereum is you use the services through a crypto called Ether, which is a type of crypto. But that's the important thing. In 2015, Ethereum was what the Genesis block was created, and in the next years, some countries started to accept cryptocurrency as means of payment, even in taxation, in taxes, for example. And next slide, please. And now in 2021, everybody knows that El Salvador accepted as legal tender Bitcoin. So what's next? I'm really sure we're gonna be surprised. But now, Ian, you promised us to show us how a Bitcoin looks like. So please be my guest.
Thanks, Victor. I'll do my best. So yeah, like over the years, I've read a number of explanations of Bitcoins and cryptocurrencies, and I find they tend to include a lot of platitudes, a lot of technobabble, and it can be really hard to find a clear explanation of what a Bitcoin really is. So that's what I want to do now. I just want to spend a few minutes and give you a really concrete, really explicit explanation of what it is you're getting when you get a Bitcoin. So Victor mentioned a moment ago that anyone can create their own virtual currency. So I think a good place to start this explanation is by doing just that. We'll just make our own little virtual currency. We're going to call it Technobucks. We're going to track it on something called the Technobuck ledger. And the Technobuck ledger looks like this. It's like a grid, looks like a normal share ledger or something that we all know and love. And the first rule of our Technobuck system is that anyone who presents on a round table with me gets some Technobucks. So Victor gets some Technobucks. That's how they're created. And now how are they transferred? Well, it turns out that I've got some email here. It's from Victor, and it says, "Dear Ian, you're doing a great job. Could you please transfer all my Technobucks to you?" Okay, so we can do that. We just update the ledger to reflect that Victor's Technobucks have been transferred to me. And now I'm feeling generous, so we're gonna pay them on to Laura. Okay, so now you've seen the whole Technobuck system in action, right? We have the Technobuck ledger. The Technobuck ledger tracks who owns the Technobucks. So then the question is, what is a Technobuck? And the answer is pretty simple. A Technobuck is exactly what is tracked on the Technobuck ledger. So it's sort of a complete self-referential system, right? So when I say Laura owns 100 Technobucks, what that means is the Technobuck ledger says that Laura owns 100 Technobucks. Nothing more, nothing less than that. Okay, so Technobucks, obviously they're not precisely the same thing as Bitcoins, but they're kind of similar in a lot of dimensions. So let's consider a few of those. So first, like, where are they stored? So Technobucks, they're stored on the Technobuck ledger, which is found in a PowerPoint file, which is a computer file stored on some computers. Bitcoins, they're on the blockchain. That's just another sort of computer file stored on other computers. Then there's the question of how they're transferred. We saw with Technobucks, you just send an electronic message to me and I'll transfer them on the ledger for you. It's the same for Bitcoins. You send a certain sort of message crafted according to certain rules to the system and it'll transfer your Bitcoins for you. There's someone who updates the ledger. In Technobucks case, it's me. In Bitcoin's case, it's basically anyone who's participating. A lot of the interesting stuff in Bitcoins is the set of rules that allows people to coordinate to reach a consensus on what the ledger should look like. And Victor will be talking a bit more about that later on. And lastly, there's the question of how you participate. So if you want to participate in my Technobuck system, all you need to do is decide that you're going to believe in Technobucks and transact in them. Similarly, if you want to participate in the Bitcoin system, you just need to decide you're going to believe in Bitcoins and buy them and sell them and use them for transactions. And the interesting thing is, even though the rules of Bitcoin technically are more complicated, it's more easy to participate because when that system was created, the people who created it, they took the rules and they distilled them into basically computer code. So if you want to participate, you can just download software and run it, and it'll basically comply with the rules for you on your behalf without you even needing to be consciously aware of them. Okay, so I can imagine there's potentially some skepticism at this point because, Technobucks are transparently stupid and Bitcoins are on the blockchain, and that sounds technical and sophisticated. So there must be something more going on there. So let's first just demystify that language of blockchain. So why is it called a blockchain? Well, the story is that for the Bitcoin ledger, the transactions are added sort of not one at a time, but in chunks or blocks. So maybe the first two transactions are one block, and then the next two transactions are another block, and then all those blocks get chained together to form a sort of chain of blocks or a blockchain. So nothing magical there. And when I said earlier that Technobucks and Bitcoin had a lot of similarities, I wasn't, to be clear, just talking totally metaphorically. If you actually look at the two ledgers, they look quite similar. So to really illustrate that, I actually went out and I bought myself some Bitcoins. So there was a transaction, someone sent them to me, got recorded on the blockchain. You can find it now. It's the 639th transaction on the 547,339th block of the Bitcoin blockchain. And if you look there, you'll find my Bitcoins. So they look just like that. Okay, so that's maybe a little bit hard to make out at home. So we can zoom in. And if we do that, you can see it's basically just a bunch of letters and numbers. And I'll admit it's not immediately apparent that this looks like the Technobuck ledger. But the thing to realize is the reason it doesn't look like it is because the Technobuck ledger was written in English. This Bitcoin ledger is basically written in sort of the language of Bitcoins. And if you just translated it into English, you'd see the sort of ideas it's expressing are quite similar. So let's just finish by learning a little Bitcoin language. So start of my Bitcoin transaction, it's 0, 1, 9 zeros and a 1. That's basically Bitcoin for start a new transaction. So it's like the horizontal line on our ledger that would appear before each transaction. And then after that, we see 0C. So C is basically the computer way of writing 12. A is 10, B is 11, C is 12. So the number 12 appearing there is saying that the person who was initiating this transaction, who was sending coins, was using Bitcoins that they'd received in 12 prior transactions. And so then the next chunk of information is just describing those 12 sources. So they're going to be using 2 1,000ths of a Bitcoin that they received in some other transaction in the past. And they describe 11 more. And then after that, you'd find the number 4. That's the computer way of writing 4. And it just means those 12 sources are going to be used to make 4 payments. So the first one was 1/10 of a Bitcoin to someone. The next one was mine. About 2 1,000ths of a Bitcoin was paid to me. So a bit of false advertising earlier. I'm not actually showing you a Bitcoin. It's about 2 1,000ths of a Bitcoin. I wish it was a Bitcoin. That would have been nice. Anyway, then it describes the last 2 payments. Then there's a chunk of information, which is basically just the transferor mathematically proving their identity, that they're really the person entitled to spend the Bitcoins from those 12 sources. And then there's 8 zeros, which is just the horizontal line at the end of your transaction saying, this is the end. Okay, so now that we've done this exercise in translation, you can see, the numbers are different, the names are different. It's talking about Bitcoins instead of Technobucks, but the sort of ideas that are being expressed in both cases are really quite similar. It's just the Bitcoin blockchain is really, when you break it down, just a ledger like we lawyers know and love all over the place. So with that, Victor, I think I'll turn it back over to you to give us a bit more insight into the Bitcoin ecosystem and cryptocurrencies generally.
Thank you very much. I think I'm going to have to consider that in my personal tax return this year. Thank you. So let us go back just a bit. We're going to explain what this blockchain, how does it work? Because Ian just showed us how the Bitcoin looks like. But it's also interesting to know and to repeat that this is a database. This is nothing different than that. But what makes it so special is that this database is supported by nodes. And please think of a computer as a node. Nodes could be like large and giant equipments, and there are farms of it. But just think of a computer as a node. So there are thousands of them. So every transaction is shared, and every transaction is synchronized and stored through the blocks that all the nodes validate. So when a node is validated, when a transaction is validated through the nodes, then we create a block. And a block is created every 10 minutes, around every 10 minutes. So in this case, that's why no one could control this. Because if someone would like to control this technology, or for example, this blockchain in the case of Bitcoin, they should have to control more than 51% of the nodes. And even in that case, it will be complicated, believe me. So I will say that to hack Bitcoin in this case, it's impossible. I will say it's impossible. So please, the next slide. So after saying that, we could say that blockchain, in summary, is just a system of recording information in a way that it makes it difficult or impossible to change, hack, or cheat the system. And this brings us to something very interesting, because we're only been speaking about cryptocurrencies, but why I'm so excited, because I think this could change the world in many other ways. You will see it in the next slide. In the next slide, we're gonna show many of the applications of big technology, and I'm talking about banking. Transactions will be much more quicker. We're talking about cloud storage, supply chain, government, media. Let me just put a couple of examples. For example, I know that in some states they're already using blockchain technology when voting for a governor or something like that. So actually, if they do that, you can't cheat in the elections, right? So there are some countries where they steal the old-fashioned ballots where you deposit your vote. So that's happening actually, and that couldn't ever happen with blockchain. That's an example. For example, if I sell cheese and I have to deliver my order on, I don't know, on Friday, but my order comes on Saturday and my cheese is spoiled, with the blockchain technology, I will know which one of my providers was late, exactly in which moment, because everything gets registered and no one could change that registry. Do you understand? So that's the importance of this. Please, next slide. If you have any doubt about any application, just write to us and we'll explain. Well, how the script is created. This is, as I said, all the nodes or the computers around the world, they pass through a process of verifying and recording transactions on the blockchain. And when there is a consensus of all the nodes, then a block is created. But there are some nodes who get a reward. Why? Let me start with a Bitcoin example. Bitcoin uses a proof of work process, which is a process through which, apart from validating, all the nodes are competing to try to solve a very complex mathematical problem. So in order to solve that, they need a lot of power. And that's why they say that there is an excessive use of power. So they're comparing the power they use with Argentina, for example, a country like Argentina's energy that they use in a year. So that could be a problem, but there is clean energy in many cases. But the important thing is that you get a reward. One of the nodes who is the first solving this complex mathematical problem, they get a reward. And we're going to speak about that afterwards, if this is an income, for example, for taxation purposes. In this case, I would like to say that now, for example, the mining of Bitcoin gets a reward of 6.25 Bitcoin about every 10 minutes. So every 10 minutes, 6.25 Bitcoin are created, and there will only be around 21 million Bitcoin ever. And this is going to be around year 2140, so we will all be dead, but that's going to happen on that year. So there's a limited supply of Bitcoin, actually. And for example, we speak about fiat money. When I say fiat money, I'm talking about legal tender money, like the US dollar. That's unlimited. So there could be many effects on just issuing money, like inflation, for example. Last year was the case with a crisis that we all know it happened. So there's another way of creating crypto that is becoming very important, which is a proof of stake method. And this method is not about competing on who is going to be the lucky one who solves this problem and validates. In this case, you have to deposit. And let's think of a security deposit let's talk about Polkadot. That's another example. That's another cryptocurrency. So you deposit dots, and then you have the right to be chosen in order to validate. And if you're the lucky one of being chosen for validation, then you can receive the reward. But if you validate a fraudulent transaction, then they will punish you with your deposit. So that's also interesting. So that's another way of creating, the crypto. And this only uses 1/3 of the power of proof of work. And well, also the miners. You will ask, okay, what will the miners do after the 21 million Bitcoin, for example, will be issued? They also live from some fees that are paid for validation. So we have two types of income here: the validation fees and the Bitcoin that is or the any crypto that is being mined or staked. Please, the next slide. In the next slide, we're gonna talk about we're gonna see how does it looks when you send a Bitcoin or a fraction of Bitcoin, because I don't have money for a Bitcoin, for example, but I have money for a Satoshi. A Satoshi is just a fraction of Bitcoin. So I request a transaction, and then the transaction with other transactions are represented by a block, and then all the nodes validate this, and one node gets its reward, and then this block is part of the blockchain, and the database is updated, and then my counterparty will receive the BTC, the Bitcoin, or the Satoshi. That's how it looks like. We try to represent this here. Next slide, please. We also have to talk about something important. I have my cryptocurrency. I need a place to store it because it's electronic. It's something it's virtual. So there are two ways of doing that: online and offline. Hot wallet or hot is online and cold is offline. So let's just start with a cold wallet. I could store my Bitcoin in a physical device, right? So I'm the only one who could open that device with my key. For example, I could have 12 words that I'm the only one who knows the 12 words, and then I can open my device, and then I can access to my cryptocurrency. And just a fun fact, 20% of Bitcoin has been lost forever because people forget about that. So that's interesting. But there's another way, like online, and that's the typical way that everyone does it. And when you do it online, you need a service, and this service is rendered by an exchange. Okay, so there are two types of exchange. The traditional exchange, or the exchange that everybody knows, is the private exchange, the centralized exchange. But there's also something very interesting, and we're going to speak about the future of blockchain, or the present and future of blockchain, which is DeFi, decentralized finance. And this DeFi thing is very interesting because there are some exchanges that are actually owned by no one. As you heard it, by no one. Who controls this? All the nodes, because it's a blockchain ecosystem, right? So I can also store my cryptocurrency in a decentralized exchange who is owned by no one. And then I will have my blockchain like saved there. There have been some cases where, for example, a centralized exchange had been hacked, and the cryptocurrency had been stolen. But for example, in some cases like Binance, they just restituted the cryptocurrency to the client. So that was good. I will choose something like that if it's online and centralized. But there's a question I want to raise here, and for you to think about. And please, the next click is cryptocurrency subject to fund freezing? That's very interesting, because in a cold wallet, think about a cold wallet, for example. Who knows? Well, next slide, please. I'm having fun. Then we're going to speak about type of tokens, and Ian, you're invited to speak here because it's very interesting. And we're going to speak about 4 and a plus, which is also a fun fact. The first one is the payment tokens, and payment tokens are just payments, and maybe a value storage. For example, Bitcoin. I could keep Bitcoin forever, and maybe in the future it's gonna worth like $1 million. It's okay, but I could also pay things with Bitcoin, as we said at first. Then we have utility tokens, which are tokens used in a specific blockchain to pay specific services. And let me give you the example I already gave. We talked about that in 2015, Ethereum was got the Genesis block. As I said, Ethereum is a platform where you can create a smart contract in order to do something, right? So actually, mostly all the DeFi ecosystem is supported by smart contracts. So there is no human intervention on that. And if you want to create that, you need to pay with something. So you pay with this token. You can only pay with Ether in this case. Or for example, there are some exchanges if you pay with their token, it's cheaper. So that's a utility token. There are also security tokens, which are very interesting because that's a way of raising money for some private projects, centralized. Okay. So in this case, I think the Securities Exchange Commission, they were like, wow, what is this? So they applied the Howey test. I think Ian knows this one very well.
Oh, it's about making an investment in a collective enterprise with the expectation of profit from another person's efforts, I believe.
Yeah.
It's US,
yeah,
I'm just Canadian.
Okay, okay. Yeah, but you have to comply with SEC regulations. So this is hard, right? And the stable coins, which are, in our opinion, stable coins are like the bridge between the fiat world, you know, the traditional banking world, and the crypto world. In the past, if I had Bitcoin, for example, in 2014, and I got a lot of money of profit, I will have to take those profits to my traditional bank, and my bank will start raising questions, what is this? Because in that year, nobody knows about this. So it was complicated. But the stable coins, thanks to the stable coins, I'm able to stay in this crypto world because there are stable coins which are not volatile, like Bitcoin, for example. So I can just change it to US dollar stable coin like Tether or like USDT. So I could wait like to, you know, for Bitcoin to drop down and then buy again with a stable coin. And I think also stable coins are the future of our money, because many countries are starting to issue their own stable coin because they don't want to lose more control, right? So, and the last, I don't know, Ian, if you want to talk about the non-fungible tokens, I think this is a way to tokenize an asset, but what do you think about this?
Oh, I think we should sell an NFT for this lecture at the end. So stick around, everyone.
Yeah, and let me just give you a brief example. If I own a unique piece of art, for example, and I want that piece of art to be in a museum, I'll be able to sell the rights on the piece of art by selling my token. So, or for example, I could there could be an athlete that I know he's gonna be like Messi, for example. So I buy his NFT, and my token will raise value if this athlete is like he's doing well. So that's an example, and this is very interesting as well. Next slide, please. Well, now we're gonna speak about a type of income that we believe it's interesting, and it's called fork. What is a fork? A fork is, you know, a change to the protocol. And every blockchain, for example, Bitcoin or Ether, or could have a fork. In this case, we're giving an example of Ether, which already have a fork. And there are two types of forks. Why would you change the protocol? Because of functionality, because there could be a breach on security. You can have a hack on the transaction, because not every blockchain is the same. There are some blockchains who are stronger than others. And in this case, Ether was an example that they had a hard fork. When there is a soft fork, there's no change, there's no new token. It just stay like that, and the change to protocol is accepted by everyone. When there's a hard fork, then there's a radical change to the network's protocol, and a new token is issued. So there's like a spin-off of So there are now two new ecosystems. So there are new tokens. So for example, miners could choose to stay in the old protocol or to be in the new protocol. But for users, which is the common way of seeing this, for example, if I had Ether, and then there's a hard fork, I will have now two Ethers, the Ether Classic and the Ether. So both of them have some value, and that could be also an income for me, right? But we're also going to discuss that afterwards. Next slide, please. And well, I think this is the future of all this decentralized finance. This is a blockchain-based financial environment with no central authority or intermediaries and no owners. So this is, wow, this is disruptive as well, because I could have loan platforms, I could have the centralized exchange, whoever spoke about that. We could have international payments and many other applications. This industry is about 13 billion worth. So the problem here, and I think OECD should do something about this. We're going to have some tax law compliance issues. Who's going to exchange information here? Who's going to be forced to do that? Anti-money laundering. So that's a challenge for administration. And we just wanted to spoke about this. And from DeFi, in the next slide, we're going to just give an example of a smart contract. As I said, this is automatically executed with no human intervention. This is all written in code, so it's not typically a contract in a legal sense. And we use Ethereum as the main platform to do this, to the Solidity language. And let me give you an example. If I want to fly from Norway to Mexico, but we have a 2-hour delay, and it's the airline's fault. In terms of the original agreement or contract that I signed with the airline when I buy the ticket, I could have a 20% refund of my money. But for that, I will have to go to the office of the airline. I will have to fill some, it's gonna be hard because I'm gonna have to wait like 3 weeks in order to get my money back. But if all this is programmed through a smart contract, then I'll get my money after 2 hours and 1 second. Isn't that amazing? Now imagine this in automatic tax response, for example. In Mexico, it's very complicated to get a tax refund. You can actually get audited because you request for one. So this will be like much more easier, right? And that's why I'm so excited now. So and last but not least, we're gonna see the central bank's digital currencies. As I said, this is an effort of at least 24 governments now that are trying to put a digital form of central bank, because they say that cash, for example, it's a disease transmitter. It's expensive to issue cash, and it's also they can have some falsification or frauds, and well, the banking system is complex. So I believe that this is also the future. We're going to be having, for example, Mexican peso stablecoin issued by the central bank, US dollar issued by the central bank. And I also think that way, well, central governments will have the way to control again this issue, because we're getting back to the centralized, ecosystem in this case. But I think it's something that we can't do nothing about that, and that's it. So now let's talk about taxation. I really hope everybody understood what I just said, and I think it's going to be easier now to understand many of the concepts that my colleagues will talk about.
Thank you so much, Victor. And always when we look at the different applications in the blockchain space, there's just so much to learn. So it was really a great overview that you gave us. If anybody has any questions or wants some backup materials to understand some of these different things, please send us a note by email. You have all our email addresses. We'll be happy to share more materials with you. So turning to taxation, and really sometimes when you look at tax and some of the things tax authorities have said, there was at first this concept that, well, there's not really much to say about tax. There's already all the rules out there. So what's the problem? Once you start digging deeper, you start realizing that every application has its own sets of issues. And we're really going back to basics on some of them. So we thought we'd start with the 3 basic questions that you should ask yourself when dealing with a crypto transaction. If you could just go to the next slide, please. Oh, sorry, I have jumped in too quickly. Fernando, maybe I can let you address this part of the presentation.
Yeah, thanks, Laura. So I like that expression of going back to basics, right? Because that's, I think, what tax advisors need to do when analyzing cryptos and understanding what is the legal nature of cryptos. So if we start analyzing the tax consequences of cryptos, it is a good way to go to study the life cycle of a crypto. So from the moment it is born, from the moment it is created, and then how it is applied, how it is maintained. So starting with the creation, and as Victor clearly explained, we have 4 main venues or means for creation. We have mining, of course. We also have a variation of mining, or an analogous mining, which is staking. We have airdrops, which we haven't discussed, I believe, but this is a minor issue, at least from the economic magnitude of airdrops, but we'll also touch that. And lastly, we have the hard forks. So that is how cryptos are mainly created. Of course, the first question that comes to mind is what happens from a tax perspective when the crypto is created. Do we have a taxable event at the moment of creation? And then once the crypto is created, can we go to the next slide, please? Okay, so we already have the crypto, and we can maintain that crypto, and we can also transfer the crypto. So the questions here are similar. What are the tax consequences of simply maintaining that crypto, either in a hot or a cold wallet? And then what happens if we exchange that crypto? If we exchange it for fiat currency, the US dollar, the Canadian dollar, the Mexican peso, if we exchange that crypto for other cryptocurrencies, or if we exchange the crypto for other services or goods. And lastly, of course, we have the issue with inheritance, donations, and gifts of those cryptos. So this is the life cycle of a crypto. Now we will go into the basic questions that Lara was mentioning. distinguishing from this jurisdiction.
Thank you, Fernando. So really, we see that as crypto is created or exchanged, there are situations where we have to ask ourselves the questions, what's happening from a tax perspective? Is this a taxable event? So the three fundamentals that we have to look at from a tax perspective is, well, what is this crypto? How is it classified in our tax jurisdiction? That's the first question. The second question is, well, when do I realize a taxable event? And that's important because of the question of when do I have an inclusion in income, but also whether there's withholding taxes that could apply, reporting obligations that could apply. That's the second question. And third, and tied to this is, well, if I do have a taxable event, how do I determine the value of the gain and loss for tax purposes? And as we walk through some of these examples in the next slides, you'll see that it becomes quite complicated. So let me start, if we can go to the next slide. Let me start by asking Fernando to give us a little bit of the answers, if I can call them, you know, they're not complete answers, but some beginning of an answer from the Mexican tax authorities' perspective.
Yeah, thanks, Laura. So I think the discussion on the tax characterization of cryptos started when cryptos started to become relevant from an economic perspective. Back in those days, we're talking about 2013, 2014, the first question was whether cryptos, or at least cryptocurrencies, could be considered as legal tender, as a currency or not, or whether this was an intangible good, or whether this had the characteristics of being considered a financial asset. We don't have a definitive explanation or a posture from the Mexican tax authorities as it is right now, but we had a lot of clarity from the other side of things, from the regulatory perspective. So as of now, it is safe to say that cryptos in Mexico are not legal tender, and this is dated back from a law we had from 1938. But going back 100 years, almost 100 years, we had a very good advancement on clarity from the legal and regulatory perspective in Mexico, which was the fintech law, in which we had our first legal definition of a virtual asset. That definition clearly refers to cryptocurrencies. When we discuss the categories of cryptos or tokens, the definition in the fintech law in Mexico clearly refers to cryptocurrencies used as a mean of payment. So Bitcoin, Ethereum, and all those type of tokens. But at least we had a clear definition from the government establishing that legal tender and foreign currencies are not to be deemed virtual assets. Then we had some advancements from the accounting perspective. We had an accounting NIF C22 from the Mexican accounting rules, which established some rules for reflecting cryptocurrency holdings in the financial statements, but these have no effects or direct effects from a tax perspective. So as it stands right now in 2021, there is still no clear definition, although it is a common posture by most tax advisors that cryptocurrencies should be treated in a general sense as property, meaning that if you purchase crypto with fiat, for example, the Mexican peso, you will not have a taxable event. That is as if I was purchasing with Mexican pesos any type of property. But if you exchange cryptos for goods or services, that would be treated as a barter, as a permuta, as payment in kind, because you have an asset which is being traded for another asset. So what you have to do is you have to consider there's two transfers of property taking place. That is also the case if we're being consistent and if we're saying that crypto is property, then we would also need to conclude that if you're exchanging a crypto for another crypto, you also have a barter. And lastly, of course, and this is, I think, the clearest scenario, if you have a crypto and you exchange that crypto for fiat, then you have a disposition and you have to recognize the income on that disposition.
And thanks so much, Fernando. Sean, maybe you can also add the US perspective on this, please.
Absolutely, thank you. From the US perspective, what we have in terms of guidance is essentially a series of rulings, a series of informal Q&As from the IRS. We don't really have clarity as to what Congress wants on this. There hasn't been, the code has not really been amended to this. And what we've done is basically we look to this guidance to determine these kind of fundamental questions. And on the first point, the IRS has stated that crypto is to be treated as property and not currency for US tax purposes. So what that ultimately means, and this kind of goes in the second question, is that whenever there's an exchange of property, there's a taxable event. So if you exchange it for another crypto, that's going to be a taxable event. If you exchange it for fiat, that's going to be a taxable event. And if you exchange for goods and services, that too will be a taxable event. And the IRS has not provided a lot of information as to kind of the subcategorizations of property. And so there's a lot of unanswered questions in the code as to whether it would qualify as a commodity or security for tax purposes, or how it would fit into the framework of subpart F, or things that are quite relevant to determining the tax treatment of cryptocurrency. Those have largely gone unstated, and there really isn't a lot of guidance as to how to determine that. As for value, again, as under any exchange of property to US law, it's tied to the fair market value. So if you exchange in a third-party transaction, it's deemed to be equal to the value received. So if you exchange crypto for money, it will be, generally speaking, equal to the value of fiat that you would receive in return. When you're exchanging cryptos on cryptocurrency exchanges, the IRS has largely respected the value of the crypto on that cryptocurrency exchange at the time of the transfer as fair market value for such exchange. But again, once you get past kind of the very fundamental questions, there are a lot of uncertainty as to how even pretty basic questions of tax are answered in crypto.
Thanks, Sean. That's really helpful, and I think we're all echoing a similar trend in terms of what has been said, and the fact that there's a lot of uncertainty left out there. If we could just switch to the next slide, real quick on the Canadian side, quite similar to what you've heard already. We have some interpretations that were issued. They're quite old, given how quickly the blockchain space has changed over the years, and how many more complexities have been added. And there's nothing, except in the sales tax space, there hasn't been legislation yet on how cryptocurrency transactions should be treated. But in essence, what Canadian tax authorities have said is also that Bitcoin is or cryptocurrency is a commodity. So they use the word commodity in the Canadian sense, not to be confused with what that might mean in the US, for example. But more they mean to say that it's treated as a property, and not necessarily always attributing to it all of the treatments that would go with a commodity. You and I were discussing this, you pointed out very astutely that even though they say it's a commodity, when they talk about whether how you determine whether you are a trader in cryptocurrency or not, so whether you should account for your gains and losses as income or capital gain, they direct you to their guidance on a securities trader, so not a commodities trader. So quite interesting little discrepancies that could have an impact in the end result. Also, the trading of crypto or Bitcoin in their actual interpretation, to buy goods and services or in and out of fiat is a taxable event, and it's treated as a barter transaction, which leads us to look to normally the value of the whatever you're giving up for the barter transaction. But if, for example, you cannot value that easily, you can also look to the value of what you're receiving. So you ask yourself, when could I not value what I'm giving up easily? Well, maybe a Bitcoin, if you're selling it, you can find an exchange to see the price of it. But if, for example, you have a scenario where you're providing some sort of services, new types of services to a new exchange or an ICO that's being put in place, and so you're being offered some sort of new token for your service, it's quite hard to say, well, what's the value of the service? How much would somebody pay for some sort of advertising of a new token in this new industry? And if I can't value that, how much somebody would pay for that? Well, what's the value of this new token that's being awarded? So there's kind of interesting outlier scenarios where it becomes, or not outlier, common scenarios where you have a harder time valuing exactly what you're selling here. And again, we also have gains or losses that could be on capital or income account, and the analysis of that comes back into play. The other, and we really do focus only on income tax here, but I did want to raise the point that in Canada in 2021, new rules were enacted from a sales tax perspective with respect to certain kinds of cryptocurrencies that meet a definition of what they call a virtual payment instrument. And so in the Canadian sales tax system, if something is a financial instrument, and if virtual payment instruments would fit into that definition, then it is an exempt supply, so there's no tax on it when it's sold, and also certain related services would also be exempt supplies. So we would push it out of the sales tax system. So this is virtual payment instrument is defined as a digital representation of value that functions as a medium of exchange and exists on a digital address of a publicly distributed ledger. So a great little definition of what's blockchain as well. But it excludes certain kinds of tokens. And Victor did a good job of showing us that there can be many kinds of tokens. So it does exclude tokens that can be exchanged or redeemed for money or specific property or services. So that would be sort of like a gift certificate. I'm again gonna just ask everybody to please mute their mics, please. Thank you so much. And also excludes tokens that can be used on gaming platforms or affinity or rewards programs. So I can't use my gaming platform tokens without having sales tax apply. So, and I just want to jump in here and answer a quick question from Isaac Lopez, where he asks us, do you think that Bitcoin being considered legal tender in El Salvador changes the nature of Bitcoin? I'm just reading your question, Isaac, as asking us, does it change the nature of the taxation if it's recognized as a legal tender? And I think it depends on whether, how that fits into your country's tax regime. I think in Canada, as you saw from this example we just gave in the sales tax context of Bitcoin or crypto being treated in certain cases as a financial instrument, it obviously removes a lot of sales tax questions. The same thing in an income tax context, if we found that Bitcoin was actually a fiat currency, the same way as the US dollar would be, then we could apply the rules for foreign currencies rather than the rules for commodities or sale of goods or property. So you could see how the characterization from a tax perspective has a big impact. And it's a big no-no to assume that the securities law characterization of a crypto equals a tax loss characterization of crypto. Oftentimes, securities law will say a lot of crypto is a security, but that doesn't mean you can treat it as a security in an income tax or sales tax context. If we could go to the next slide, please. Great. So I'm going to turn it over to Fernando to start with our first case study on exchanges.
Thank you, Laura. So what we're going to do now, of course, we had a very brief introduction on the tax classification and treatment of cryptos. But as we go forward to these examples, I believe that some other key questions will arise from the perspective of taxation in each of the countries. And when we analyze which examples to take, of course, we thought about exchanges because of the economic importance of exchanges. Just to give you some numbers, in 2020, the total amount of trading volume in exchanges, at least the most recognized one, was of $1.8 trillion. That is almost twice Mexico's GDP. So this is a very important economic phenomenon we are having, and it deserves some analysis from a tax perspective. And starting on this, I would just first distinguish what Victor explained a while ago, the difference between centralized exchanges and decentralized exchanges. As it stands right now, the most important ones in terms of economic value are centralized exchanges, but the current is starting to change, and we are now seeing the more use of decentralized exchange. The difference from a tax perspective is very relevant because centralized exchanges mean that there is an entity or an intermediary that is operating the exchange, and that entity is usually constituted under the laws of a specific jurisdiction, and is usually also a tax resident of a certain jurisdiction, which enables tax authorities to have some certain powers of control over that intermediary, and therefore over the trading of the cryptos that take place within that exchange. So aside from that, maybe we will start from the Mexican side of things and then move forward to Canada and the US. For me, one important point of centralized exchanges is how they work from a technical perspective. Most of the centralized exchanges have a custodial activity, meaning that if you're a trader and you are engaged in trading within a centralized exchange, what you actually do from a technical perspective is that you are transferring your cryptos or your fiat to that centralized exchange, right? So the examples, for example, that Victor was mentioning concerning the hacking, we've heard a lot in the news about hacking of cryptos. Most of this takes place because the cryptos of the centralized exchanges are held within the wallet of that centralized exchange. So that wallet is exposed to hacking. So that's one important point. But from the Mexican perspective, the first point to clarify or to assess is that owning cryptos is legal. It is a legal activity. But if you're operating as an exchange, you have to take a look at the activities that are exclusively assigned to financial institutions in a traditional sense, and also to the new fintech institutions that were enabled from 2018. So the reaction of the industry in Mexico, we have around 12 exchanges that operate primarily to the Mexican market. Of course, most of the worldwide exchanges are accessible from Mexico, but we have around 11 or 12 which are mainly focused in the Mexican market. So when this new legislation from a regulatory perspective in 2018 came into effect, there was a mixed reaction. Some of them tried to go into discussions with the regulatory authorities and try to obtain some sort of authorization to act as a fintech company, as a electronic payments fund, to have the right to receive funds from traders and then operate them as an exchange. Most of them were not able to obtain this permit. So what we had in the end is a mixture of restructures from an operational perspective to avoid non-compliance with the Mexican regulatory side of things. And that also had its own tax effects. Those that do operate in Mexico are subject to stringent anti-money laundering obligations. And this is because, of course, Mexico, as a characteristic of the country, is heavily involved in this sort of regulations. So those that operate as exchanges have a lot of anti-money laundering obligations. They also have KYC obligations, but it is still not clear what are their obligations from a tax perspective. We don't have any clarity from the tax authorities. However, it is important to mention that a couple of years ago, Mexico enacted some modifications to their tax legislation to impose obligations on digital platforms and digital platforms that engage in intermediary operations. These rules were primarily aimed as traditional intermediary platforms such as Uber or Airbnb. But if you are being consistent with what we're saying about cryptos, we're seeing that cryptos are actually property. So it is not clear the position of the tax authorities as of right now, but one could interpret that these new obligations for digital platforms that engage in intermediary operations could end up applying to exchanges of cryptos if these exchanges perform intermediary operations in which property is being exchanged. I spoke with the tax authorities in Mexico, which operate the digital platform obligations. And as of February of this year, there has been no exchange that has registered as such. But and I believe that as it stands right now, that there is not enough clarity from a tax perspective to go ahead and register as such. But I think that the thought here is, where could the tax authorities go in trying to levy taxes on traders? And of course, it is much easier to go against the operator of the trading platform instead of to each specific trader. So perhaps in the near future, once the anti-money laundering obligations are settled, once the KYC obligations are settled, and the tax obligations start to become relevant, we could see the Mexican tax authorities trying to attempt establishing tax withholding obligations and tax informative obligations on exchanges operating in Mexico.
Next slide, please.
So yeah, having said the Mexican side of things, I don't know if we should stop and discuss this from the Canadian and the US perspective on the exchange. Would you like to talk about that?
Sure. Sure, I'm happy to, Fernando. So in the Canadian context, there's frankly very little guidance on the tax front about exchanges. I find it interesting because it sort of harkens back to questions that I've heard from more senior tax lawyers people were worrying about like 30 or 40 years ago. Because if you just have shares on sort of a normal exchange, you probably hold them through a broker. That broker, maybe they're engaged in securities lending or something, like all sorts of stuff could be happening under the surface. And once upon a time in Canada, people worried, like, does that mean that there are some strange tax consequences for the shareholders, for the people who are, for the individuals who own the shares and are trading through the exchange? And I think over time, people just got comfortable that you could ignore all of that. And if you were buying and selling shares through an exchange, it would be treated just like buying and selling shares. So on that basis, despite the lack of guidance, I'd be quite surprised if the tax consequences of buying and selling through buying and selling cryptocurrencies or virtual currencies through a exchange was treated as anything from a tax perspective any differently than from just trading in them directly. In terms of reporting obligations, there are some certain sorts of reporting obligations that apply to dealing through exchanges in regular securities in Canada, but those are all quite old. The definitions long predate even like anyone thinking about Bitcoin, let alone any other cryptocurrency thing. So those aren't really caught. So I wouldn't expect the exchange to have tax reporting obligations with respect to these virtual currencies. I think one interesting reporting angle, though, could be that Canada has a system for reporting foreign currency, or foreign property. So if you're a Canadian and you own sort of foreign property, like foreign real estate, shares owned overseas or anything, and with a tax basis of more than $100,000, you need to create this onerous list and send it to the Canadian government. So I think a big concern would be if you had cryptocurrency and you held it through an exchange that was based offshore, then that could count as foreign property for the purposes of those rules and trigger a reporting obligation. The definition of what's caught under those rules is quite broad. It covers all sorts of intangibles, so you could be caught under that. Yeah, otherwise, I don't think there's too much interesting to say about how the exchanges would be taxed in Canada.
Yeah,
That's good.
You make a good point about the potential reporting, because the CRA, the Canada Revenue Agency, did come out and say that reporting should be done. But there was always a lot of questions about how do I know my property is foreign property? Is it where is the exchange located? Do I look to where the servers are? So a lot of practical questions that come up. I just want to also point everybody's attention to an interesting comment from Michael Evers on the chat just now, where he does raise the point that in the European Union, the Commission is drafting a new reporting obligation, DAC 8, which I understand will require reporting of cryptos and ensure automatic exchange of information. So to be followed to see whether that's an inspiration to our tax authorities as well. Go ahead, Fernando, sorry about that.
Sorry, if I could just add one more point on the Canadian front. I think like some of our other regulatory authorities are actually more ahead of the curve relative to our tax authorities. So there's recently been the extension of, for example, anti-money laundering rules to virtual currency dealers in Canada. But our tax authority seems to be a bit slower on the mark on this.
And I think that it would be very relevant to hear from Amanda on the US side. It seems that Mexico and Canada are still unclear on that. Can we go back to the last slide before we jump into the perspective of the trader? Thanks, Yan. So Amanda, what do you think of the taxation on the exchange by itself in the US?
Sure. So I'm actually going to spend my time starting with really focusing on the investor or trader side, because that is really where we do have some interesting guidance from a US perspective. I think that for much of this presentation, you're going to hear from myself and Sean that on the US side, we have many more questions than answers at this point, especially when we get into some of the more complicated fact patterns. But we do have some guidance on some issues on the investor side. So I'll focus on those. And so some of this is really expanding on some of the issues that Sean raised in his great intro and some of the guidance that we do have. So first, if you go back to 2014, that was when the Internal Revenue Service's first piece of guidance on cryptocurrency came out. And it covered some basic, but still very important issues about cryptocurrency. So one, being that cryptocurrency is treated as property for US tax purposes and not foreign currency, subject to foreign currency gain or loss. And I take the question that was brought up in the chat about El Salvador. And I think that for now, that doesn't change the US treatment. If more countries begin adopting some form of crypto as a legal tender, perhaps we could see that reevaluated, but I don't think it really changes the analysis now. A couple other basic points that the IRS made early on is that general tax principles apply to property transactions that also apply to virtual currency transactions. And as we'll talk about later on, that's going to be important because when we don't have specific guidance, we do have to try to figure out how do we address the unresolved issues under existing law. As Sean said, exchange of virtual currency results in gain or loss. And some other basic principles such as payments made in cryptocurrency are subject to information reporting to the same extent as any other payment made in property. So a couple years ago in 2019, the IRS came out with some guidance on the tax treatment of cryptocurrency forks. And we heard a great discussion of that earlier. So in the 2009 guidance, it basically involved two fact patterns involving hard forks. So again, a hard fork being where a blockchain undergoes a protocol change that results in a permanent diversion from the existing or legacy blockchain. And this may result in the creation of a new cryptocurrency on a new distributed ledger, in addition to the legacy cryptocurrency that was on the legacy distributed ledger. So the first fact pattern that the IRS addressed in the ruling was where there was a hard fork and the taxpayer did not receive any units of the new virtual currency. And in that case, the IRS said the taxpayer did not have gross income, which seems relatively straightforward. The second fact pattern has raised some questions that I'll talk about. So in this fact pattern that was presented, the taxpayer received new virtual currency in an airdrop following a hard fork. And I'll talk a little bit more about what the criticism was, but what the IRS conclusion was is that in that situation, the taxpayer had an accession to wealth, and therefore under our general tax principles has ordinary income in the taxable year in which the new virtual currency is recorded on the distributed ledger, but only to the extent that the taxpayer has dominion and control over the new cryptocurrency. So the revenue ruling has been criticized as really potentially misunderstanding the mechanisms through which new cryptocurrencies are actually accessed after a fork, as well as the difference between an airdrop and a hard fork. The IRS also in its guidance didn't address, well, what happens if there's a standalone hard fork or if there are airdrops outside of a hard fork. An airdrop often occurs, for example, where there's like a promotional airdrop where someone is trying to get more people to adopt a new cryptocurrency. And both of those are really more common fact patterns than what was presented in the guidance, which was a hard fork followed by an airdrop. So in subsequent guidance that came out earlier this year, there was some clarification of what the IRS had said earlier. And in this particular guidance, the IRS addressed a taxpayer who received the new cryptocurrency Bitcoin Cash as the result of the Bitcoin hard fork in 2017. And in this case, the tax authority said that the taxpayer did have gross income because the taxpayer had an accession to wealth of the new Bitcoin Cash. And then the IRS elaborated on some of the tax consequences, including that the date and receipt and fair market value is dependent on when the taxpayer obtained the dominion and control over the Bitcoin Cash under US tax principles. And the ruling also clarified that the specific means by which the new cryptocurrency is distributed or otherwise made available to a taxpayer following a hard fork does not affect the holding of the earlier revenue ruling. And the focus is on whether and when the taxpayer has dominion and control over the new cryptocurrency. As Sean had mentioned earlier, the final pieces of guidance, if you want to call that, it's not formal guidance under our tax law. But the final piece of guidance that the IRS has issued are a series of questions and answers on cryptocurrency that are posted on the IRS website. They've been updated a couple times, including earlier this year. There's a couple of issues that relate to investments that might be held through exchanges. There's a couple of specific things that are addressed, like soft forks, some valuation issues, how taxpayers can designate particular cryptocurrency that's being sold. So that's basically the extent of what we have from the US side in terms of crypto-specific guidance. And as we'll talk about as we go on, in the absence of specific guidance, taxpayers have to apply general US tax principles to determine how a crypto-related transaction is going to be taxed, which in turn is going to depend on the particular facts and circumstances. As we heard earlier with respect to the other countries, there's often a question about what type of property is cryptocurrency. In the US, our non-tax regulators to some extent have a view on this issue. So for example, certain tokens may be treated by our securities regulators as securities, certain cryptocurrencies may be treated as commodities by our commodities trading regulator. But the IRS does not defer to those definitions from other regulators. So many uncertainties can arise under US tax rules where you have to classify property as a security, a commodity, or something else. And then finally, the last point I want to make on this topic about exchanges themselves relates to some issues we may come back to later if there's time, and that's about information reporting. This is becoming a major issue in the United States, including right now, because there's been some very recently proposed legislation to require brokers to report digital assets, and the definitions in the draft legislation of broker and digital assets are extremely broad. So it's really generated a lot of concern in the cryptocurrency community, and there will likely be continuing efforts to educate our US Congress on the crypto market and potentially try to change the scope of those rules if it is adopted. Separately, Treasury and the IRS, so our tax policy makers and tax administrators have been working on administrative guidance that would extend certain existing broker reporting to exchanges. We haven't seen anything on that. That's been something they've been working on for a while. It's likely that getting those proposed rules out may have slowed down a little bit with the new administration. And then finally, just a comment on foreign exchanges, or foreign with respect to the US, and FATCA related issues. Again, no specific guidance in that area, some unresolved questions. In my practice, I think a lot of it really just depends on the specific facts and circumstances and what an exchange is doing, what types of assets it's holding, whether it takes deposits, for example. But that's something else where there's a great degree of uncertainty on the US side. So with that, I will pass it back over.
Thank you, Amanda. Before we jump into the next topic, which is mining, Ian, would you like to add something on the Canadian side from the trader perspective?
I think I covered that, but I wouldn't mind saying something on the Canadian side about the forks question, if that's okay.
Of course, yes.
Yeah,
yeah, sure.
So there's really, again, no guidance on how forks are going to be treated in Canada. I would have thought, well, I expect, like Amanda was saying, it's going to be sort of contextual and depend on the circumstances. I could imagine different sorts of circumstances having different results. But I would have thought in a lot of typical fork examples, like if you take the split of Ethereum into Ethereum and what was it, Ethereum Classic, like they now have two blockchains. They go back before the time of the fork, they share a common blockchain. So I would have thought you could have taken the position that really both of those cryptocurrencies always existed. And it was just the case that they were sort of stapled together up until the time of the fork, at which point they became unstapled and could be traded separately. And if you're taking that sort of view of it, then it's not, I wouldn't think, a taxable event. It's just that you had two properties and now they've become separated. You're going to split the tax basis up between them. But otherwise it wouldn't be a taxable event right at that moment. So I don't know if anyone considered an argument like that in the US context, Amanda?
Yeah, so there has been discussion of that point in the US. And one of the analogies that people often bring up, which sounds kind of silly, is the sale of a pregnant cow, where the cow then gives birth to a calf. And is the birth really a subsequent taxable event or not? So it's kind of funny that in this environment of sophisticated technology, we are going back to some old US tax principles that have been applied to livestock.
What's the answer?
Well, it depends on who you ask.
Okay.
But yeah, we know, at least we know the IRS's view is expressed in those revenue rulings.
Yeah, someday we might find out. Someday we might find out the Canadian answer for sure.
Yeah, and also the Mexican one, because I mean, I haven't even gone into the Mexican side of forking because there's no clarification from the tax perspective whatsoever. I like that example of the pregnant cow. Maybe we could attempt that. We have a very broad definition what income means for tax purposes, which is any increase in the wealth or patrimony of the taxpayer. So we could see the tax authorities trying to assess income if the fork results in obtaining an additional crypto. But again, there's no clarity on that. But it is funny for me how we are using this very basic example of the pregnant cow, because of course we're going to jump right into mining. So I think that's another example of how very old terms are being used now for these new technologies. So why don't we go into mining? Ian, could you switch over the slides?
Sure.
Thanks. So we also wanted to cover mining because of its economic importance. It is still one, if not the most important way in which cryptos are generated. And there's a lot of questions from the tax perspective. We're going to use two examples to go through those questions. I think that the main topics that we will cover here is whether when the crypto is generated as a consequence of mining, that could be considered as a taxable event in Canada, Mexico, and the US, or whether we have to wait until disposition of that crypto. I think that's the main question here. So we're going to use an example. Here's the example. CryptoX is a proof of work cryptocurrency. Alex, an individual, uses his computer to mine new coins of CryptoX. So Alex is the miner here in this case. He mines one new coin of CryptoX on June 21st at 3:43. And at that point, the fair market value of the crypto is 10. Later on August 20, in 2021, that a few days from that, Alex sells that one coin of CryptoX to Betsy, an individual, for 20. So there's a difference between the moment in which the crypto was mined and the fair market value at that moment, and of course the price in which it is sold later in the week. So why don't we start this topic with asking Sean. Sean, how do you see this from the US perspective?
Absolutely. So mining was one of, Amanda had mentioned that in 2014, the IRS gave their first notice out where they gave kind of some initial answers to how virtual currency, what the IRS calls cryptocurrency, would be handled. And they gave their interpretation of how these rules would work. So walking through these examples, I'm going to this example, at least in mining, I'm going to follow very much what the IRS's perspective on this is. And then when we talk about staking, I can talk about some different ideas on this. But from the IRS's perspective, when Alex mines that new coin, he has an income inclusion. In there, they stated this, that he would have, as of the date of receipt, it would be includable in gross income. So from the IRS's perspective, Alex would have ordinary income of $10 at the date the coin was mined. But then he would hold that coin, he would have a basis of $10 in that coin. And when he would later sell that coin, that $10 would be capital gain. In this example, it's been over a year since he mined the coin. So when he sells it to Betsy and she obtains the coin and obtains right and title to the coin, at that moment, Alex would recognize $10 of capital gain. And it would be long-term capital gain, which from a US perspective is a much lower rate for individuals than short-term capital gain or ordinary income. But this is really how the IRS has viewed this framework, and certainly the framework of mining. And this has been the IRS's position for, since the 2014 notice, and we first had any insight as to how the IRS would approach virtual currency transactions.
Thanks, Sean. Before we jump into stake and whether there's any difference on that, I would like to hear from Ian. Ian, what do you think from the Canadian perspective in this case?
Yeah, so this is the one place where we have clear guidance from the Canadian tax authorities, really. In fact, so much that we have contradictions. So first, the first iteration of their guidance under these circumstances would have said that Alex has $20 of income on August 20th, 2021. Basically, you only recognize the income when you sold the mined cryptocurrencies. A few years after that, they turned around and said, no, actually, Alex is going to recognize income when he mines them based on the value of the cryptocurrencies mined at that time. So I guess following the US position. And then what the tax treatment is on the subsequent gain from then is going to depend on sort of his intention in holding them. Is he holding them speculatively, or are they capital property to him? If you take seriously the CRA's position about cryptocurrencies being a commodity and think that you can apply all the normal commodity administrative positions, and it actually might be possible for Alex to make an election to have it treated as capital property. So he could recognize a capital gain on the 2021 sale and possibly less tax at that point. And the one big proviso to all this is in Canada, we don't just tax accessions to wealth, or we don't tax necessarily all accessions to wealth. We just tax sort of sources of income, things you do with a profit-making purpose. So if you were mining and you could really establish that you were just doing it as a hobby without the intention of turning a profit, then this might all technically be non-taxable. Though I think as a practical matter, if you're doing this, if you're mining on any sort of material scale and earning any sort of substantial amount of money, that's going to be a very hard argument to make to the tax authorities, that you just have this warehouse full of mining rigs as a hobby.
That's very interesting. So the objective or the purpose of the mining it could vary the tax classification.
Yeah, it's the subjective intent really of the mining.
That's interesting. And I would add, before jumping into Victor for the Mexican explanation, the OECD studied this in the report they published last year, at the end of last year, and most of the countries recognize or establish income, the first taxable event, from the moment of mining. So it is interesting to hear the different perspectives. Victor, what do you think would happen from the Mexican side?
Thank you, Fernando. I think it's well, Mexico, as you already said, Mexico has no guidance on this, and well, the answer depends on whose perspective is this. I particularly thought about that in Mexico you will receive the Bitcoin mine in the example of a Bitcoin, and I'm pretty sure that our tax authorities will think that your income will come at the moment when you receive. So that's something I'm pretty sure it will happen. But I also think that there are a lot of arguments to sustain that actually you could recognize income when selling. Because I was discussing this with some colleagues, including you, and well, discussions they got hot. We really started. This was very interesting. But from my particular point of view, it is very likely that our tax authorities will say that the income will come when you receive the income after mining. I was thinking about, for example, when there's a real mine with real gold, for example, in the moment that you get the gold, that was the argument that some colleagues were having. That are you gonna recognize that you got a kilogram of gold, for example, right now, like as an income of when you sell it? But repeating, I really think it's when you get the income after mining.
Yeah. So maybe if I could just expand on the Canadian piece, like I think the reason why they switched from one position to another was sort of exactly what Victor is alluding to there. Like originally they were taking the position that mining was sort of the business of producing cryptocurrency for sale. So you sort of manufacture this cryptocurrency, it was your inventory, and then you recognized income when you sold it. But later on, they came around to viewing it as basically a service fee for validating transactions on the blockchain. So then you're getting paid for the service as you perform it.
Well, hopefully that's where we would go from the Mexican perspective, right? So going forward to the next case, and this is very similar but different in some specific characteristics to mining, is the staking. So staking, Victor explained it a moment ago. I'm going to use a case to go through the consequences from the tax perspective. In this example, crypto Y is a proof of stake cryptocurrency. Christina, an individual, owns 100 coins of crypto Y, and Christina operates a node that validates transaction on the blockchain. Christina stakes her 100 coins on the node she operates. On June 22nd at 2:21 p.m., Christina creates a new coin of crypto Y by operating her node and staking her existing 100 crypto Y coins. At 2:21 on June 22nd, the fair market value of crypto Y is $5. On August 20, Christina sells the coin to Dan, an individual, for 20. So we also have that difference. We also have that spread of 20 to 5. So we would have a gain. But let's see what would be the difference between a mining case and a staking case in this example, Sean.
Yeah. So unlike in mining, the IRS has really released no guidance on staking whatsoever. There's not any formal or informal guidance that kind of tells us how to answer this question. And so what I kind of want to do is there's really two approaches I think that one can take here, and there's really two ways of interpreting this. One is to kind of, by analogy, as we discussed in the mining case, to say that there would be an ordinary income inclusion when these tokens were created. These new tokens were created, and then when those tokens were eventually sold, there would be a capital gain or capital loss on the value of the tokens. But ultimately, in US tax law and kind of in the history of US tax law, the first owner of newly created property is never taxed. If somebody goes and bakes a loaf of bread, they're not taxed when the loaf of bread comes out of the oven, they're taxed when the loaf of bread is sold. When cars come off the factory of Ford Motor Company, the cars aren't taxed when they're created. They're not taxed when they're sold. One possible interpretation of this, and perhaps the correct interpretation of this, would be to say this is newly created property, and thus, until there is that actual sale, there shouldn't be an inclusion event under US tax cases. And I can cite Glenshaw Glass and kind of the traditional, for those of you who went to law school in the US, you'll read this your first year, these kind of very traditional fundamental income cases. Reading those, it doesn't really seem to capture as an income inclusion the creation of new property. So that's one potential argument. In fact, my colleagues at Fenwick and I were actually litigating a case in U.S. District Court now on this actual issue, arguing that the creation of new property and the inclusion of tokens generated through staking on a cryptocurrency that's similar to this model here, that inclusion of tokens should not be income when received, but that rather only income when sold. So this is really uncertain, and there's been kind of, the IRS has been very firm in that they, 7 years ago came out with a rule on this, but ultimately US tax law is incredibly unclear as to how it apply that. And I would argue, I think the better interpretation would be that it's the first owner of created property. In this example, Christine is the first owner of created property, and that until she sells the coin to Dan, there wouldn't be income. So just kind of a couple different perspectives from US law on that front.
Thank you, Sean. We're running out of time here, so I'm going to ask a quick yes or no question, and then Ian, if you think we need to stop over, we can do that maybe later. Is there a clear difference from the Canadian tax authorities between mining and staking?
No guidance, but I don't see why it would be different.
Okay, Victor, how about you from the Mexican side?
No, my answer is the same. I only think that there's a barrier of the deposit, as I said in the past, that could be considered. Maybe you could have some adjustment, inflationary effects that could be deductible for you. But if you lose your 100 coins in the example, it's not gonna be deductible. That's the only additional thing I wanna add.
Yeah, definitely. Thank you for that. We're gonna turn over to the next example. Laura, could you walk us through it?
Thanks, Fernando. Next slide, please. So we wanted to show you an example of a crypto-backed loan, and there's different ways that that lending can be done with crypto. Of course, you could have a direct loan to a borrower who wants a miner, for example, who wants to take the crypto, sell it, buy some rigs and mine, and then pay you back with some return once he's mined his or she's mined her crypto. But what we're starting to see now, and it goes into the distributed financing examples that Victor was talking about at the beginning, is these platforms that allow for somebody to borrow based on the crypto they hold and use that borrowed crypto to do something else. So in our example, we have somebody called Subject A who has paid 2,500 for Ether, and in this Ether is now worth 2,400, and he's looking to buy crypto X, a new crypto, but he thinks that Ether is going up in value, so he wants to hold it for dear life. That's what HODL means. And so he will stake his Ether in order to borrow some Tether at $1,800 with a 9% annual interest rate, and use the Tether to buy his crypto X. And if we go to the next slide, please. What happens to our Subject A? Go ahead. So after 1 month, the crypto market goes down in value. We've seen that happen many times, so it's not far-fetched. And the collateral auto-executed, so his loan is paid back, and the interest of or the return of $13.50 is paid. He also sells off his crypto X because he thinks the whole market's going down. And so now he's got himself to have to report all this. So what are the questions we ask? Well, first of all, what happens when the lender lends the original Tether? How is that treated? And I'll tell you, there's a good question of whether that in itself should not be treated as a disposition. What happens when there's the automatic execution of the contract and the crypto X is sold, or sorry, here would be the Ether is sold, and the Ether is sold to pay back the loan. Well, obviously there's a disposition. How are we treating that return on the loan? Is that return interest? Is it some sort of rent? And it matters for different purposes. Obviously, it matters as to whether or not it's a deductible expense to the payer. In our case, we had a fact pattern that said he doesn't do this as a business. It's an occasional thing. So the question is, did he borrow in order, and that he paid this amount for purposes of as an expense for purposes of earning income from business? And the characterization of whether this is a loan and its interest or not interest may have implications for what rule you apply to the deductibility of that return of $13.50. Another case where you have to ask the question is whether when the lender himself or herself is a non-resident of the borrower's jurisdiction, because then you might have withholding taxes that apply. So looking at a Canadian perspective, you would say, well, is this rent that I'm paid $13.50 on the borrowing of that crypto? Well, rent normally would lead us to think, well, I still need to own the crypto, but I sold it to buy something else. I sold it to buy the crypto X. So it's not really the way that I rent a car and I have to give back the car and I pay a rental fee for the car. But if you look through your own jurisdiction's rules, the Canadian rules, for example, the withholding rules for rent at Part 13 of our Act are broader than that. And they do include at 212(1)(d) subparagraph 5 or 5 little I, as we like to say it, the sale price of property. So you could have 25% withholding, theoretically that should be done on that return payment of $13.50. And then you say, well, okay, what about the treaty? Well, the treaty doesn't have a definition of rent or royalty broad enough to include this kind of payment, so you might be out of luck. Or maybe it's interest, and Ian and I had a nice debate over, does it really qualify as interest if it's a return on not on money, as we in the fiat sense of the term? But if it were, for example, to be seen as interest, well, then it could be falling into what we call participatory interest, participating interest, sorry. And then you have Canadian withholding tax on that, and you go to the treaty and have to work through, well, does it fit into the participating interest definition in the treaty that would get me to a lower rate, or does it get exempt under Canada-US treaty because it doesn't fit in that definition? So there's not clear answers. There's not even easy to know where the lender is located. And when we talked earlier about the platform's obligations, you could see that if tax authorities really wanted to crack down on this, they would need to somehow empower and or use the platforms as a go-betweens for the identification of these payments to non-residents, but also as collectors probably of the required tax. So with all that in mind, I'm going to turn it over to Amanda to give us some more of her thoughts on what the US treatment might be of this kind of scenario.
Yeah, sure. Thank you, Laura. And I think we'll see that, you know, as in Canada, in the US, there's not specific guidance on any of these issues. And many of the questions that you were just raising are also questions that we would raise in doing a US tax analysis. So again, is a theme that I think we've been discussing with respect to the US, is that when we don't have specific guidance, we're left to apply our general US tax principles to determine the tax treatment, and how those principles apply are going to depend on the specific facts and circumstances of a given transaction. So to start with here, while we're using the word loan, that label is not dispositive for US tax purposes, as it sounds like it may not be for Canadian tax purposes. So what we're referring to on these slides as a crypto loan could be classified a number of ways under US law, depending on the particular facts. So some potential characterizations are a loan, a rental, or a taxable sale or exchange, depending on the facts. And then these characterizations would then in turn drive other consequences, a lot of the things that Laura mentioned, such as whether and when there's income, whether payments related to the transaction are deductible, how we source the payments for US tax purposes, and whether payments to non-residents are subject to US withholding tax. One issue that comes up with loans involving cryptocurrency or transactions that are referred to as loans involving cryptocurrencies is that unlike money, which is fungible, it doesn't really matter which dollar I pay you, cryptocurrencies for US tax purposes are treated as property. So sometimes these transactions can raise an issue about where property is transferred, whether there's a taxable exchange. And a test that we have under US law to determine whether there's a sale or exchange of property is whether what's called the benefits and burdens of ownership to the property have been transferred. And that's a multi-factor test that's been developed through our common law. There can also be a question in these transactions about whether a specific US provision that relates to securities lending under section 1058 of our tax rules can apply. And basically what that provision does is it can prevent gain and loss in securities lending transactions. So sometimes in these situations, you'll have questions about whether that particular provision applies. But again, bottom line from the US side is that often there's many questions and not clear answers on these questions. And one needs to apply existing general principles to determine the tax consequences.
Thanks, Amanda, and that's very, very relevant. Victor, do you want to just jump in with a 1 minute comment on the Mexican interpretation that we could see?
Thank you, Laura. I'm gonna be very quick because I know we're out of time. In this case, it's a very sad story because in case subject A, we're having a profit, he will have to tax on that on a 35% rate. But since in this case, let us think about the CEO who has his savings and he invested here. So it's not a business activity, as we said. So in my case, well, in the Mexican perspective, I think neither interest will be deductible, nor the losses that he obtains from the execution of the warranty through the Ether, and after selling crypto X, he also obtains a loss, and that's also non-deductible. So that I think the message here is that it's urgent for our tax authorities to, well, for the Mexican side to update our law, because when deducting these type of things, they only speak about immobile property and shares, and that's it. So if it's not immobile property and it's not share, it's not deductible. So it's amazing, but I think Fernando is going to talk about that in the next section.
All right, Fernando, take it away.
Yeah, I think we have the last section of the presentation. Thank you all, which is the challenges for tax administrators. We're gonna broaden the scope and also make this a sort of conclusion stage. So here, the broad question would be, as tax advisors, what is your position right now? What would you recommend your clients? Do you think that your clients are at any risk of different interpretations? I believe Sean is in charge of this from the US side. Sean, what do you think from the US side?
Sure. And then of the US laws, as Amanda and I think have said pretty much consistently over the past hour, we've been talking about this, is uncertain. There's a lot of unanswered questions. There's a lot of places where there's of course risk in taking any tax position simply because we don't know what the IRS will come out with it. A lot of the focus kind of in the administration level now has been about information reporting. Congress, as again Amanda mentioned earlier, Congress is a pending bill before Congress that would expand the definition of broker to include potentially every crypto entity that you could imagine, or entity involved in cryptocurrency. it could be narrower, and how that will shake out in the wash is something definitely to pay attention to. You know, the IRS has also used pretty aggressive tactics going after the cryptocurrency exchanges to get information about taxpayers, getting the equivalent of a subpoena to go in, using what's called the summons power to go in and get information about taxpayers. So it's been really clear the IRS has taken strong positions on crypto taxpayers, on entities involved in cryptocurrency ecosystems. And with the amount of uncertainty, there's always going to be some level of risk in whatever position you're taking concerning cryptocurrency.
Thanks, Sean. Laura, what about the Canadian side?
Yeah, so it's very similar to the US, probably getting inspired by what the IRS has done. The Canada Revenue Agency has also gone after exchanges to get information regarding their large holders of crypto. More recently, we saw in March of 2021 that CoinSquare was asked, and then they took it to court, and finally they do have to report significant holders of account holders and transactions to the CRA. They've also gone out and sent questionnaires to investors and traders they could identify, very detailed questionnaires. I think one of the questions was, do you have anything else you need to tell us? And I think that kind of effort is important, because there are quite a lot of unreported gains in the crypto space, and it's important for taxpayers to at least be able to do a voluntary disclosure if they realize that they're ready to report anything that they have not reported in the past. So the trend has changed from perhaps a view in 2016, 17 that crypto is outside the tax sphere, to a realization that crypto is taxed and that it's better to report on a good faith basis, making a best effort at proper fair market value and cost basis and gains reporting, than to wait for the tax authorities to identify you through some other exchange of information that they obtain, and then you have sort of to live with the penalties and interest that come with that, if not more. So that's sort of what I see Canada right now. I'm also seeing efforts from the tax authorities to get better and smarter about how they audit, and part of that is getting access and getting in partnerships with crypto tax accounting providers in order to have the right kind of software and data processing capabilities, which I think is a big factor in this space, because the sheer volume of trades and information sources and data is quite difficult for the actual reporting. So those are kind of really important practical topics that are very top of mind. And the thing that I always say to my clients is that you should not live with the belief that they will never find you, because I think there's more and more technology out there that's allowing for that kind of identification of participants in the blockchain space who have gains that should be reported.
Thanks, Laura. And hearing you and Sean, I think that there's a clear difference between where Canada and the US is right now and where Mexico is. And very quickly, I think that if you take a look at literature and on tax policy concerning cryptos, and even what the OECD recapped last year, the first stage is concerning cryptos to secure economic stabilization, right? Avoid cryptos being disruptive for the macroeconomic scenario of each country. And the Mexican government started the process of adopting cryptos in that sense. They clearly established that cryptos should have a safe, they call it a healthy distance between the traditional financial system and cryptos. The next step is, of course, fraud and anti-money laundering, which the Mexican government is active on. And I believe we are just entering the third stage, which is taxation. We still don't know which way we're going to go, but of course, definitely because of the close connection with the US and Canada, the Mexican government will take a look at what you are doing and try to establish some sort of grounds on that. As it is right now, Mexican advisors are left with applying general principles of taxation and recommending clients to establish their position and secure or gather a defense archive or a defense file for when the moment comes when the tax authorities start assessing this type of operations. So having said that, I think that we will jump into the few questions we are able to answer that. I'm going to answer 2 questions from the Mexican side that were mentioned in 1 minute. The first one is whether the El Salvador positions on Bitcoin could change the classification in taxes in Mexico on Bitcoin. I know what you're saying. The definition of foreign currency could be applied to Bitcoin now that El Salvador recognizes it as legal tender. However, I believe it is not the case because of 2 requisites for foreign currency, which is that it has to be physical. That's an interpretation. It has to be physical, and Bitcoin is not physical. And the second one is that it needs to be backed by the central government, which clearly is not the case. So that's for El Salvador. And the second one, I think there was a question on the electronic funds for fintech in Mexico. There's no clear tax answer. From my perspective, the funds that you deposit on a fintech operator are a credit right. They are not a disposition or exchange for cryptos, because the fintech is not the entity making actually the exchange. And there's a clear example in Mexico, which is Bitso. It is not Bitso making the exchange, it's another entity of the group, which is governed by another law, which is making the exchange of cryptos. So I think that could be sustained, but of course it has to be on a case-by-case analysis, because let me give you an example, and with this I'm gonna wrap up. What happens if the exchange serves the Mexican market, but it is governed by another law, which allows it to receive your fiat currency and then exchange it for a gateway coin, such as Bitcoin, because of, let's say, liquidity reasons. And then once you have the Bitcoin, you start operating the market. Then would you have 2 taxable events? One, once you do the acquisition of the Bitcoin, and then when you exchange it. It has to be a case-by-case analysis. We won't have time for that, but that's the answer. Ian, would you like to go over the quantum question?
Yeah, there was a question basically about whether quantum computing threatens to create chaos with digital currencies and central bank digital currencies in particular. So I'm not an expert on this, but my understanding is, like, right now, Bitcoin and lots of other cryptocurrencies use a form of public key cryptography that's known to be vulnerable to quantum computers. So if you did have a quantum computer right now, you could get up to all sorts of mischief. But I think there's no fundamental reason that they need to use that particular form of cryptography. So if they saw that quantum computers like that were on the horizon imminently, I think they would just change all their protocols to use different cryptography.
Yeah,
so
yeah,
they wouldn't have anything to worry about.
There are no incentives for that. I think it's much more convenient to invest in equipment in order to mine than to try to hack. And as of today, I don't think that with quantum technology you could hack Bitcoin, for example. Now, if there's no enough security on the CBDCs, I think that, well, I don't know which the incentives will be, but I think it's now the incentives are to invest, to validate the transactions and to mine. That's it.
All right, well, I think we are a little bit off time, guys, but I don't want to thank you all again. We've just had a great discussion. I have personally learned a lot. We want to thank you very much, all of our speakers and moderators, and also the YIN leadership that has been here listening to us, and also to everyone that has joined and has had the patience of staying with this very interesting topic. I just have 2 things to mention here. In my perspective, cryptocurrency and blockchain it seems to be the future in transactions in the world. And as always, law and tax framework seem to be always behind the industry evolution. So what we will be seeing, of course, as it happens usually with this type of situations, is the tax administration from a tax perspective looking on how to tax this, which has been all what we have been discussing. We have a level of uncertainty, and there's a huge degree of lack of legislation in the respective countries. So we end up falling into general taxation principles. So, I mean, I stay with a comment of Laura at the end of her participation that we cannot just forget that and think that in this type of transactions, the tax authority will never find the ones that are realizing income through this means, because at the end of the day, we're talking about technology, and we're certain that tax administrations are very good in using technology. So they're going to certainly find at some point everyone that will that is doing income through this, and we have to make sure that we are prepared. So thank you again very much, guys, and please stay tuned for the next events that are organized by YIN Mexico, YIN US, and YIN Canada. Thank you again.